In this video, I'm going to show you how you can get paid to buy your favorite stocks and collect juicy premium along the way until it happens. But not only that, you're going to buy stocks with other people's money. Can I have some money? I want to buy some stocks. It's a great thing. We're going to collect juicy premium over and over until we buy stocks. And then once we do, we're using other people's money to buy the stocks. I'm going to show you guys everything you need to know, how to get in, which stocks to buy, how to execute this strategy and print juicy premiums safely, passively, and consistently, allowing you to retire and do things that you want to do without stressing out and looking at your computer every single day. One thing I want to point out about selling put options is that you want to find stocks that are near the bottom or at least at a support line or demand zone. This way, you're not selling put options on stocks that are at a ceiling or at a supply zone that could go down, putting you in the red immediately. There's a strategy to this. I'm going to show you everything you need to know. Let's dive right in right now. Before we get started, I want to explain to you guys that when you're selling put options, you are essentially committing yourself to buying that underlying security or stock. If you were to get assigned, you would be buying the stock. So you only sell puts on stocks that are of high quality and stocks that you already intend to purchase. This is very important to understand, and you want to do it on stocks that are near a bottom or a support or a demand zone. Like I said, I'm going to show you exactly how to do this. There are multiple strategies. The first one is how to enter the stocks with the intent to buy and collect juicy premium from other people and take their money and add it to your account consistently, safely, and passively until you get assigned the stock. If you're wondering what an assignment is, well, when you're selling put options, an assignment means that the stock price has dropped below the strike price of the put you sold, and you are obligated as a seller to purchase that stock on the expiration date. If you don't want to purchase the stock, you can buy back that put option that you sold short. You can buy it back to close it at a loss, or you can roll out further in time and lower in strike price to avoid getting assigned. This is a way to save your money, generate more passive income, and get a cheaper price on the stock. When you sell put options, you are selling to open and buying to close. This is not a put option that you're buying. You are selling this and collecting a premium. It's safer. You're getting a discount on the stock. Let me show you how to pick a good strike price as well as a good expiration on Palantir and Meta. And I will also show you some put options that I have on Meta and Microsoft as well. If we're sitting here looking at Palantir, we want to get a sense of where the bottom truly is. And in order to understand that, we will turn on the Bollinger Bands. And typically I like to sell put options when we're looking at the 4-hour and daily chart. And on the 4-hour, we have the Bollinger Bands, and I have them set to the 20 SMA, which is the simple moving average, which is really good. But the 20-day length with standard deviation of 2 on the 4-hour is essentially going to give us a 1 or a 2 week window, meaning in the next week or two, Palantir going below $82 is very unlikely. If we click on the daily chart, this is going to essentially give us the moving average over the last 100 days. And this is very strong with a standard deviation of 2. It's pretty much 99% accurate, meaning it's pretty much almost impossible at this point for Palantir to go below 77. So if we were to go a month out, which is what I use the daily chart for, I would sell $75 to $80 puts, somewhere in that range. However, if I'm going to sell put options weekly and bi-weekly, well, then we want to go right below the average of the Bollinger Band, which is right here, 85.02, right on this support, which is in line with my $84 puts that I had been selling over the past few weeks. If we go to the 4-hour chart, we can see that 82 lines up perfectly with that. So we really want to look at $82 puts going roughly 1 to 2 weeks out. They would be very safe. And if you get put the stock, you're essentially getting paid to buy the stock cheaper with other people's money. On the RSI, we can also see we have bullish divergence right here as the stock is coming down and the RSI is diverging, which shows the stock is going up. We can see that the 10 crossed above the 20 right here, and right here, the orange above the blue, and they're crossing over this black line, which is the 100-day moving average. So the stock is now moving above its lows. So we want to go below that to sell our puts. The stock is crossing over. So we are going to go below all this down here and sell $84 or $85 puts. But then I want to be even safer and come down to the 82 to 83 range, making sure that we have a lot of room to breathe if the stock goes down. If I'm going out 1 week, I will sell $82 to $84 puts. If I'm going 2 weeks out, I will sell $80 puts. This way it gives me a little bit more breathing room on the stock, but we can see there's already bullish momentum. So on the whiteboards here, I want to show you guys why this is powerful. We're going to look at Palantir, okay? So we have person number 1 right here, person number 2 right here, 2 different traders, 2 different styles of trading. At the current price, we look at Palantir, and Palantir is $90. What we're going to do is we're going to say that trader number 1 right here is going to buy Palantir at $90. Okay? And then we're going to look at trader number 2, buys 100 shares. Trader number 2 is going to sell put options at $90, which is going to be a lot of premium, a whole lot of premium. $90 put times 1. And we're going to see how much premium that this trader is going to collect. So we're going to go to Palantir, click on puts, and we're going to look only at March 28th. $90 put options are worth $250 roughly. They'll probably go down a bit in the morning if the stock goes up, but we'll just say $250 to be safe. So this individual is going to make $250 on the puts. So we have this situation playing out week number 1. Let's say Palantir goes to $89. Well, this trader is going to get put the shares, so essentially buying 100 shares at $90. So we're going to move this premium actually, $90 times 100 shares. And then over here, we've got the put premium of $250. Okay. So now the stock is at $89. Week number 2, it's $89. We're waiting for the stock price to come down a little bit. So this trader decides to wait. The stock falls to 85 and buys 100 shares at 85. Well, this trader over here decides when the stock is at, let's say, 85 or 86 to sell an $85 put option, which is the same price that this trader is buying the shares, but he's selling a put option. Now, an $85 put option is going to be right at the money, very similar to the previous put, which is another $250 put. Now we're going to repeat this scenario. The stock plummets. This trader gets assigned. The stock goes to $80 or $81. In week number 3, trader number 1 decides to buy the stock at $80 times 100 shares. And we're going to say the same thing happens. This trader sells an $80 put, and the stock drops to 79. He gets assigned, but he collected another $250 premium. So to recap this trader bought 100 shares at 90. This trader sold a put at 90. The stock dropped. They both now have shares. The put seller got assigned, was forced to buy the stock at $90, using some of the premium collected, of course, which lowers the average cost. We'll get into that. This trader over here buys another 100 shares at $85. This trader sells an 85 put, gets assigned because the stock goes below 85. Week number 3, this trader buys 100 shares at 80, and this trader sells another put option. Now, he gets assigned or she gets assigned again. So they have identical portfolios, but let's add them up and show you the difference and the power of actually selling put options. So the average here is $9,000 plus $8,500 plus $8,000. And then you divide this by 3. The average cost is $8,500. So there you go. $85 average cost. Perfect. It's going to be the same for this trader right here, or this individual, because the same strike prices. Wait, we forgot to look at the put premium collected, which is $750. So what we're going to do is we're going to go back to the original total, which is $25,500, you see? And what we're going to do is take away $750, leaves us with $24,750 because we collected that premium and it's ours to keep no matter what. And we use it towards the stock of our choice that we sold the put on. So in this example, that's $750. The $250 each put totaling $750 is applied towards the purchase price of the stock. So we do that, we minus it off, and then we divide by 3, giving us an average price of $82.50. So a lower price by quite a bit, $2.50 per share lower, because we sold put options. This is the power more of selling put options. But we're also going to look at something else. We have to look at dollar cost averaging and risk. If you have a $100,000 portfolio, you don't want to have more than 10% of your portfolio in one stock. So what I recommend is you would essentially have 10,000, maybe 15,000 to put into one stock, and you'd want to go about 30% the first put or several puts, and if the stock drops, you use your next 3% to dollar cost average, and then your next 3% to dollar cost average. I like to do 3, 6, 9, possibly 12%. This way you can dollar cost average. So on a $100,000 account, you can do 3,000, then 3,000, then 3,000, then maybe another 3,000. On a $200,000 or $300,000 account, you could do a lot more. 6, 6, 6, and 6. 6,000 each time. Now, if you have a $100,000 account, it's up to you. If you want to go larger and do 8,000, 8,000, 8,000, that's 24,000. That's 24% of your portfolio. You have to be very careful. If you have a smaller account, you can do this strategy on SoFi, no problem. It's $14. It's much smaller. But this gives you a breakdown of how selling puts generates safe passive income, because you can collect all these premiums, and if you get put the stock, you have a lower average, and then you can turn around, sell covered calls, wait for the stock to come up, and make more profit. If the stock was to stay at $85 and only go up by $2 in this example, this trader or individual would make $2 a share, and this individual would make $5 per share. So it's a lot more premium because the puts lower your average cost, and your brokerage will, or at least most of them, will average this out in your share cost or your total average cost. As you can see on Meta right here, I have 100 shares at an average cost of $656, but I got put at $670, which is totally fine because I collected $1,400 over the course of 3 weeks on put premium. But I also have a $620 here that I've collected almost $3,000, and I will roll that one out and down when it's close to expiration, which is going to be this coming week, March 28th. I will roll it out to May, probably May 2nd, collect another $1,000 or $2,000 and roll out. So this put right here is March 28th expiration. I will roll that out to May 2nd or May 16th, roll down to $590 and collect another $500, putting me at $3,500 premium. And if I get assigned at $590, my average cost is actually $555. So then I'll have another 100 shares at $555 in May, and that'll split between the average cost of $656 right here, which gives me an average cost of $606. So all I have to do is roll this put out an extra month and down to $590. And even if Meta was to go down to $550 or $560, my average cost would be $600 at 200 shares. It lowers from this $656 right here, but I think that's highly unlikely to happen. Meta is already working its way back over $600, so it's likely that this $620 put that I have will expire worthless this week, and if it doesn't, I could still roll out 2 weeks and roll it down to $610. Either way, I have options, literally and figuratively, to keep collecting premium and lowering the strike price. This way I can utilize this put consistently to generate more money to offset the loss on this 100 shares right here. If I get assigned, it will lower my average cost. If I don't get assigned on this, then I end up collecting $5,000 or $6,000 over the next 2 or 3 months. That's going to come off of this position while I wait for it to recover. But essentially, this is what you do with put options. I'm aggressively selling $620, and now I'm going to sell $590 to $600 to collect as much premium as I can every single week, so that if I get put the shares, it's going to be an average between $590 and $656, which is essentially roughly around $620 minus my premium. So I'll be in the $610 range, maybe $605. So that's really good. It's only $10 away from where Meta is right now. So that puts me right there. And when Meta moves, I will be in the green. So to understand that, my average cost is $656. I've already collected $3,000 on this put. So I'll roll out a month to $590 and collect another $500 premium. So that gives me $3,500 premium and a $590 put. If I get assigned in May, the difference between $590 and $656 is $66. Divide by 2 is $33. Take away 33, giving me an average cost of $623. But then I've collected $3,500 in premium. So $6 $52,300 minus $3,500 in premium, giving me an average cost of $58,800. So essentially $588. This simple strategy takes me from a $656 average to a $588 with 200 shares by utilizing the power of selling puts and collecting juicy premiums. So now I will be at $588 if I get assigned at $590. So essentially, long story short, using this strategy means that right now Meta's at $590-ish, $595. I have an average cost of $656. I roll this 620 put out to May to $590, collect more premium, and if I get assigned, I will have 200 shares at an average cost of $588, which would be $2 below the strike price of that put option, or $7 below the strike price, or $7 below the current price. This is how you dollar cost average and sell put options. I also have $400 put options on Microsoft, which I collected $1,400 per put, $2,800, which I sold a few weeks ago, and I collected $600 the week before that. So for the month of March and the last week of February, pretty much the last month or 5 weeks, I have collected about $4,000 on 2 puts I've been selling consistently on Microsoft. With that being said, if I get assigned the stock at $400, you have to deduct $2,000. My average cost would be $380 per share, and I would have 200 shares. That would put me $1,100 in the green on both stocks, even if I was assigned this week, which means the stock can fall as low as $380 this week, and I'm still at break even on these $400 puts. So I'm going to show you on 2 different brokerages how you can sell put options to generate safe, passive, consistent income. I'm going to give you an example on Robinhood as well as Fidelity. But not only that, I also want you guys to understand that selling put options near a bottom or when a stock is at support means you are likely to not get assigned with my strategy. So if you're looking to get assigned, it's probably less likely because I have a safer strategy. So right now, the way I'm showing you to get into stocks, you would likely just continue to collect premium, which is exactly what we're looking to do. So let me show you how you can do just that. And this is what I teach my students in Discord and in coaching. This is the most powerful strategy. If you guys are interested, the link is in the information box below to join coaching, Discord, as well as the full training course. So let's take a look at Palantir going a week out. We're going to click on sell, click on put. We already decided that 84 going a week out would be good. This has got an 81% chance of success with a delta of 18. That's not too bad. Remember I told you guys going 1 week out would be somewhere between 82 and 84. I prefer 83. 16 delta is a lot safer. You'll collect $78. So if you're able to say sell 3 of these, well then you're going to be making $233 a week, and this is going to be pretty decent for the month. You're going to collect pretty much $1,000 a month to sell these puts. And if you're already looking at buying 300 shares, then you can just continue to sell these puts. You just want to make sure to keep your eye on the candlesticks, the moving day averages, the Bollinger Bands, the RSI, like I showed you, to make sure that as the stock rises and you're raising your strike price higher and higher, you're not getting too high. I, at this point in time, would not sell put options above $90. Even if the stock goes to 190 or 92, I would have to revisit the stock price, revisit the charts, because right now 90 has got some decent support. It did break it and fall into the 75 to 78 range briefly, which is why I think 80 to 85 is the best range right now on Palantir. But looking at the $78 per put is very strong. If we're going to go out 2 weeks or even a month, well then I would want to look maybe closer to $82 or $80, giving us more breathing room. So it's a little bit less money, but you collect more up front. And this is powerful. This is a very powerful strategy I teach my students in Discord as well. If we believe Palantir is going to run all the way to $100 or higher, you can't sell the weekly put options for $78 at 84, because then after week 1, Palantir will be at $96. You won't be able to sell an 84 because the price goes up. So you have to raise your put option up to 88 or 89. And after the week after, and then after the 3rd week, it'll go up again and you'll end up at 90 or 93. So you're not going to be able to consistently sell $84 puts on Palantir if the stock keeps going up, because your premium will go down and it won't be worth it. So in the event that we feel the stock is going to run, we sell a put option going 2, 3, or even 4 weeks out, and there's a benefit to that. So the put option for $84 on Palantir 1 week out is $95. Essentially, if we were to do this 4 weeks in a row, we would make $380. So we would expect if we go a month out, we'll make $380, right? Well, not entirely. If we go a month out to 84, which would actually be April 25th, we will notice it's $385. So it's about the same with volatility, but usually this will drop, and it probably will in the morning. But if it doesn't, the volatility on this option is actually up, but usually we don't. I would expect that when the market opens, this will likely drop to like 350 or 360. We lose anywhere between 3 to 5%, sometimes 10 or 15% when you go further out and longer. And you'll notice it happens on larger stocks a lot more often. Let me show you exactly what I'm talking about. So if we go to Microsoft and I want to sell a put option for this Friday for $380, it's worth $115. If we do $115 times 4 going a month out, we should get $460. So if we feel the stock is going to move a lot and we're going to miss the move, I will sell the put going a month out. See, 30 days out, I will sell this 84 and I will collect 3 of these. Click premium on 3. There we go. $1,200 up front. When the stock starts moving, it's immediately moved away. This is the most powerful thing we can do in selling puts. We are looking at the stock price right now in the 1 hour and 4 hour chart. We can see that it crossed over, and we're going to go down here to 84 and sell this put option right here. And then over the next week or two, maybe even sooner than that, the stock comes up and does this number here. And now this put that we collected $1,200 for 3 of them is worth maybe less than half, maybe $300 or $400 or $500. So we can buy to close those, and we've made 50% of our profits in like 10% of the time. When I sell put options, whether it's weekly, bi-weekly, or monthly, if I've made 50% or more in a quarter of the time or less, I just buy them back for a profit most of the time. For example, if you sell a put option going 1 week out, in 1 or 2 days, you're up 50%. There's no sense in waiting 3 or 4 more days for 50% if you've already got your first 50 the same day or by the next day. And sometimes you'll find this is very powerful to utilize this strategy, because let's say you sold an $84 put on Palantir when it was $90. On day number 1 and 2, the stock goes to $95. You're up 50%, and you don't buy to close and take your profits off the table. Wednesday, Thursday, Friday, Palantir drops to 85 or 84, and now you're at risk of assignment and losing money. You cannot go broke taking profits. As an example, if you sell puts on Palantir, let's say right here at 84, and the stock was to come up, bounce, come back down, and it sits right around 84. So it sits right around here. It does not matter if it closes at 84.01. You are in the green, technically, to not be assigned, but just understand that options can be exercised up until 5 p.m. You cannot sell or buy options past 4 p.m. So if the stock closes at 84.79 at 4 p.m., you're thinking your option expired, worthless. But if something happens between 4 and 5 p.m., news related or something that's bad with the company, and it sells off, you will be assigned after hours, or you could be, and likely to be assigned. So just understand that if you have a put option and the stock is above the strike of your put, even if it's only a few pennies or even if it's a few dollars, it doesn't matter. It's always best to just buy it to close. This way, you're not at risk of assignment. So Palantir was at 84.50 at 3:30 or 3:45 p.m. You could probably buy this option back for $5. Don't ever let a position like this go into the after hours thinking you're okay when you could very well be in trouble. It makes no sense to put yourself at this much risk for $5 or $10. If you collected $100 for the put, even if you got to close it for $20, you still made profit. It makes no sense to allow your put options to go into the after hours between 4 and 5 p.m. any day of the week, especially Friday. this is a very powerful and important tip to remember. You either buy to close or you roll out to next Friday at the same strike, or you can lower your strike price and also collect a premium. I also teach this to my students in Discord consistently. I teach this to my students in Discord every single coaching call. This is just one of the many tips that I give them and strategies that helps them to continually and consistently make profits. Another thing you can do is you can consistently roll your puts and keep the same strike price. Let me show you. So I told you I would give you an example on Fidelity. Well, here it is. Let me show you exactly what you can do. I have this Meta put and this Microsoft put. I could take the Microsoft puts at 400 and click on roll, create a custom roll and go from March 28th to April 25th. And I could keep the same strike price at 400, collect $370. I could actually get 480 now. Roughly. Click preview. I have 2 of these. So essentially, I'd be collecting $1,000 to go out a month and keep the same puts. So if the stock stays at 390, doesn't matter. I have theta, time value, which means I've added more to that, so I will not be assigned, which I will show you exactly what theta value is. But I can continually roll these puts out, and if the stock goes to 405, 400, 390, anywhere between 390 and 400, I'm in the middle, I can just keep rolling out and collecting premium. And after 6 months or more of doing this, I will have such a low average cost. Right now, I'm already around 380 for average cost. If I continue to do this for another few months, even if I get assigned at 400, my average cost will be closer to 330. And I want to build up the premium. The longer we do this and the longer we keep generating these premiums and keep selling the puts, if and when we get assigned, which eventually will happen if you continue to sell these puts on the same stock, eventually you will be assigned. You will have a much lower dollar cost average or average cost of the shares. So if you've collected $10,000 in premiums over 2 put options over the course of 8 months, well, then it's $5,000 roughly per 100 shares, essentially giving you $50 off the stock price. So if you get assigned at 400, you're really getting the shares at 350, which is very good. So if the stock drops to 370 and you get assigned at the 400 after selling them for 6 months, you're still $20 in the green and you can start selling covered calls. It is a very powerful strategy when you couple good stocks, patience, good strike prices, and technical analysis on the stock to time it to get in when it's at a support, a demand zone, or closer to the bottom. So this way you're not selling put options at the top, because this would make no sense and would increase your risk. So if I want to close a position, let's look at Bank of America. I would just click buy to close. I'm up 23%. I collected $384 per put. I don't mind clicking limit and buying them back for $305, which means I made $79 times 8. I've made a lot of money on Bank of America. It's only 25%, but this is how you would buy to close. When you sell puts to open, you buy those puts back to close that naked or cash secured position. Whether you're selling naked puts or cash secured puts, you are buying back to close the position. So you can see how powerful it is to sell puts consistently every single week to make passive, safe income and collect juicy premiums to buy your favorite stocks with other people's money and to also lower your average cost. You just have to remember to sell put options on stocks that you already want. This way you're not upset if and when you get assigned, but not only that, most importantly, on high quality stocks. And understand that they're stocks that are of high quality, stocks that you want, and also using technical analysis to find good entries and good strike prices. And understand risk management. No more than 10% of your portfolio in any one stock. You could push this to 15% if the stock is good. I do this, but this is my own personal account. It's your money. It's ultimately up to you. But if you are looking at selling puts, remember 3%, 3%, and 3%. This way you can dollar cost average. You don't go all in at one time. Hopefully you guys learned a lot in this video. I look forward to seeing you on the next video. If you guys want to sign up and join my Discord and my live one-on-one coaching and full training course to take advantage of everything that I know and want to teach to help you grow, you guys will be able to click the link. It's in the information box below, investwithcorey.com. Click on training, watch a video, book a call with my team and I so I can help you grow your portfolio. I look forward to seeing you on the next video and in the Discord real soon. Take care, fam.